Let's get in Karthik Kumar, the fund manager with Axis Mutual Fund. So, sir, firstly, to start off with, markets have been quite volatile over the last couple of months. So, as per your understanding, what is causing this kind of volatility in the market? Is it the flows or is it the weak earnings expectation, which could also come in the third quarter of FY25? And how are you looking into the markets for the next calendar year 2025?
Firstly, thanks for having me on the show. So if you look at markets over the last 3 months, yes, they have been volatile, but also we need to put it in perspective because despite the correction that we've seen, so the last 3 months markets have been down anywhere between 3 to 6%, depending on the indexes you look at. But over the year, large caps have been up 15%, mid and small caps have been up around 28 to 30%. So we've seen a good healthy rally, and I think what we've seen over the last 3 months is also part of the markets, and it's a very natural part of the markets where markets do cool off at certain points in time. This time around, they were driven by essentially two aspects. One is FI outflow, firstly into China and then into more developed markets, specifically the US. And then second, obviously, was the slightly tepid earnings season that we've seen so far across sectors. Those were the main drivers. But the fact is, markets not panicking because if you look at just the style performances, what you notice is that high volatility stocks are still doing well. Small caps are doing better than large caps are holding off, outperforming their large cap peers. Both are signs that the markets actually looking at it much more constructively in a larger construct. And looking forward to 2025, we are quite constructive on the markets. Obviously, a lot of it comes down to bottom-up stock selection. But in terms of style, what I expect is, given that we've seen a tepid earnings season and subsequent earnings cuts to our earnings growth expectations for FY25 and 26, earnings as a style becomes quite important to track because that given that we are in a kind of earning cut cycle, stocks that do well on that parameter can kind of outperform markets. And also in environments like this, typically quality and also low volatility stocks tend to do well. So that's how we are looking at it from a market perspective and underlying style perspective.
Okay, Mr. Kumar, thanks for that view coming in. This is Snehi also joining in. Wanted to get your sense of whether you are penciling in some improvement on the earnings front in quarter three and overall also for the second half of FY25. And if so, if you do see growth coming back, which sectors do you think could lead this growth, especially when it comes to earnings?
So even today, in terms of earnings, our earnings expectations for both FY25 and 26 is, even if you were to compare it globally, we have one of the highest growth expectations. So yes, the earnings are cut, but have been cut over the due to the tepid earnings season last quarter. But the fact is, despite that cut, we still have healthy growth rates for both this and the next financial year. So then it comes down to essentially looking at tracking whether companies are able to meet what is expected of them for the second half of the year. That becomes quite important, and which is where positioning comes into play. And so in that context, we continue to remain bullish, selectively names within the discretionary space spread across different subsectors. We also remain overweight pharma, and then I have healthy exposure to capital market plays as well. Whereas I continue to remain underweight commodity names, some industrials as a sector as well, and then private banks.
Right. So, given that you're underweight when it comes to private banks, are you more bullish when it comes to PSU banks? Is that the play that you have currently?
Within financials, the way it is split is I'm a bit underweight large private banks, but I do have exposure to other smaller private banks. And as I said, I also have healthy exposure to capital market plays because that is where a lot of the growth is. And so that's how the portfolio is positioned
While you're
right
having
now.
some exposure when it comes to capital market ancillaries, aren't you worried about the valuations of these stocks? They have run up quite a bit right now.
They do have run up quite a bit, but given that the growth is still quite solid and we are able to see there is growth visibility that we are able to see, and the earnings are constantly expectations are constantly keeping up with increasing meeting market expectations, and hence, as long as those things hold true, I think I'll be comfortable being in that space.
Okay, and let's talk about the record low, the fresh low that we've seen on the rupee now. This also will lead to some sectors gaining from this happening, the likes of outward-facing sectors like an IT or maybe even a pharma. What is your stance when it comes to both of these sectors, and how would you play the pharma space going ahead? Is CDMO your big bet? Is it going to be the healthcare and the diagnostic space? What's the outlook on that front?
So I think pharma and IT will be natural beneficiaries if this trend kind of continues. Um, Within pharma, within IT, I'm largely positioned in the large cap space rather than the mid and small. And within pharma, less of CDMO, but more of the pharma generic plays with exposure to healthy exposure to US markets.
Right. And sir, what is the kind of earnings growth that you're expecting? You did mention that there have been earnings cuts so far that we have seen because of weak set of numbers coming in. But for say FY26, what is the kind of earnings growth that you're expecting?
So for the earnings growth expectation generally across the street, if you look at it on an average, is around 14% for FY25 and 26 prior to the last quarter results, and they've typically been cut by 3 to 4% across the board.
Okay, and one name that stands out to me from your Axis Blue Chip Fund is Zomato. Now, we have been hearing over the past couple of days there are new players that are entering into this quick delivery space. Quick commerce is heating up. There's a lot of competition building, with Swiggy also now becoming a listed player. Would you still continue to hold Zomato going ahead as well, or would you even consider for a moment to include Swiggy in place of Zomato? How would you play the space, and what's your pick between these two names?
So we do like the space in general, but I can't comment on stock specific issues in here, so I'll stay away from that. But I think the whole space in general looks quite attractive.
Okay, well, on that note, Mr. Kumar, thanks so much for joining us. We'll let you go. Thanks for speaking to us on ET Now. But viewers, time.
If you like this video, then like, share and subscribe to ET Now.